The topic, as you all know, is on host governments and oil companies' relationship in today's market conditions and trends. When Dr. Victoria and I agreed on the topic, that was perhaps maybe 2 months ago or 3 months ago, and the oil markets looked quite different from what we are seeing today, drastically different, I would say. And this is just to give you a flavor of how things can change fundamentally in the oil industry and can lead to new realities. And in turn, that will affect the relationship between host governments and the oil companies. I'm particularly fascinated by the history of the oil industry, which is more than a century old, because a lot has happened in the structure of the industry, from the dominance of the oil companies and the move towards nationalization in the 60s and 70s, and appearance of the national oil companies, which are still with us today, to a more diverse market structure, industry structure, with IOCs, international oil companies, and national oil companies cooperating in most of the countries. But in general, we tend to see a spectrum with two extremes. On one extreme, and perhaps that extreme has few representation in terms of countries, we still find some countries, particularly members of the OPEC organization, such as Saudi Arabia and Kuwait, which remain to date close to the private sector, even though the private industry started the development of oil in those countries. So there are very few countries on that extreme aspect of the spectrum. And on the other extreme, we have countries which rely solely on the private companies to run their industry. And this is particularly the case of the OECD countries, or in other words, what we describe often as developed economies, such as the US, Australia, and the UK. And most of the other countries tend to fall between that spectrum. Now, that said, even though we have a wide spectrum, one country can easily move across that spectrum in one direction to the other, depending on a combination of both below ground factors, but even more so above ground factors. Some would affect the industry globally, and others are more country specific. Now, as you know, oil and gas projects are by their very own nature long-term. So really, we're talking about activities, if I start from exploration all the way to development, production, and then the field reaching the end of its economic life, we're talking about several decades. Now, I was just referring earlier to how things can drastically change between 1 month to the other, let alone over several decades. And this is why we expect, like, the relationship between the government and the industry, which was perhaps under a certain format or arrangement, contractual arrangement at the beginning of the field, let's say, life cycle, to look quite different perhaps towards the end of that project. And among the things that can change, I mean, I'm thinking about unexpected major discoveries, for example, as we saw in Guyana more recently, and before that in Israel, which was seen as an oil and gas poor area, and yet they hit some of the largest gas discoveries in 2010. Other changes, which I'm going to dwell on a little bit more, which is the oil price. Think about the collapse that we have seen in the last months or so. Politics and social disruptions. I'm thinking about eruption of protest in countries such as Lebanon, where I come from, and Iraq, which is a major oil producer, Venezuela, even wars such as in Yemen and Libya. The health of the global economy can go through lots of changes, from recession to rapid growth. And as we saw recently, major health issues such as the coronavirus can have big impact on the health of the industry, the oil and gas industry, with implications on the relationship between government and the oil industry. And if I look beyond the current crisis, if I look a little bit towards the longer term, then we have the issue of the energy transition. What does that mean to this relationship and to the oil and gas industry? So what I intend to cover with you in the next 40 minutes or so is, first of all, looking at the the main factors, I cannot cover all the factors, otherwise it will take us a couple of hours, but on the main factors that we have identified as often triggering a change in the host government industry relationship. And then I'm going to zoom in on one particular instrument that companies tend to use to minimize the fiscal and political risk in a country, and we're going to question whether this is the way forward. And then at the end, conclude with a little bit looking forward, and then try to understand where would that take us, especially taking into consideration the conditions today. So let me start first of all with highlighting the main factors that can shape the relationship between the host government and the industry. I mentioned several factors. However, if you ask me, I mean, all these seem to boil down to one fundamental driver behind the direction that the relationship between government and oil companies will take. And it is the concept of fairness, particularly when it comes to the sharing of the proceeds from an oil and gas projects between these two players. And I describe it an inherent instability in the industry. So if you look around the world, and here I picked up only two areas, Alaska and Liberia. If you look around the world among major oil and gas producing nations, and you ask them, what do you want to achieve from the oil and gas industry, from the fiscal regime, from the contractual arrangement? And often they tend to say, we want to achieve a fair share of the rent, or a fair share of the value, or equitable return to the country. But it all revolves around the concept of fairness. However, in my 20+ years of work focusing particularly on this kind of sharing between the government and industry, I haven't been able to pinpoint a single definition that would apply anywhere, anytime, of what constitutes a fair share. Are we talking about 50-50 for government and industry? Or is it 60-40%? Or is it 70-30? I think that it can be any of these, because the dynamics of what constitutes a fair share of the rent continuously changes. So for example, if you have a government which had a share of 50% when the oil price was $50, that share suddenly becomes unfair when the oil price doubles up and goes to $100. And it becomes also unfair to the industry if oil prices go down to $20. So you see, it's constantly changing. And as a result, I wouldn't be surprised to see that when we talk about stable relationship between industry and government, I think it's more of a wishful thinking, or maybe, well, in other words, we mean minimum instability. Now, here is a list of the factors that I will go through. Maybe I spend a little bit more time on other factors and on some factors than others. But in a nutshell, you have the most obvious factor is oil price. And then investment trend, which are closely related, but there are other factors that can affect the investment trend. Production life cycle. Is a province at the beginning of developing its oil and gas reserves, or is it towards the end a mature province such as the North Sea, for example, the UK and Norway? Politics can play a big role. I'm going to give you an example of what's happening in Venezuela. Regional effect. We talk about the herd's instinct, or what others are doing, what the neighbors, what the competitors are doing, and we tend to follow their practices. Government finances, are they in good shape, or are they deteriorating? And then I wasn't sure how to call this, but I called it public interest, electorate interest, the main drive of policies in the future. And here I want to spend a little bit of time on the energy transition. Let's start with the first factor, that is the oil price. For me, I call it the most obvious factor, because it plays a major role in determining the degree of the bargaining power each party brings to the negotiating table. And typically what we see is that when oil prices are high, governments tend to have the upper hand. But when oil prices go into the other direction, so they collapse, then the pendulum swings in favor of the companies. Although the reaction to falling prices in terms of government reaction tends to be slower and more erratic than what happens when oil prices increase. And I want to, there was an interesting study published by Chatham House showing the number of arbitrations in the industry versus the oil price. And they found an interesting relationship whereby whenever oil price increase, then you see the number of arbitrations increase as well. And when the oil price decreases, the opposite happens. There are almost no arbitration. And you know, arbitrations result when there are disputes that are not resolved amicably between host government and the oil industry. And when they cannot agree, so something must have triggered renegotiating the contractual arrangement, and as a result, it leads to disputes between the host government and the industry. And here, one particular country I am fond of, which is the UK. And I wasn't sure whether I should show you the longer history of the UK from the 80s till now, but that would be perhaps too much. It deserves a session on its own. So I looked only at the last 2 decades, and I picked up a couple of measures related to one fiscal instrument. And you can see how the UK government seems to be chasing the oil price. So in 2002, when prices were on their upward trend, they introduced a new tax called the supplementary corporation tax at 10%. Then a few years later, in 2006, as the oil prices kept on growing, they doubled that rate to 20%. Then fast forward, yes, we had a small, a shortly lived blip in a decline in prices following the economic recession of 2008, 2009, but prices recovered quite quickly after that, largely courtesy of OPEC cuts. So you can see that in 2011, the UK government further extended that tax rate to 32%. However, when we had the collapse in prices after summer 2014, and we kind of remained in a lower price band, the UK government, first of all, they announced that they were going to reform the fiscal regime to make it more attractive and for investment and compensate for the decline in prices. And 2 years later, in 2016, they went back to where they were in 2002 with their supplementary corporation tax rate. So that's what I call the swinging pendulum. But as you can see, how the government is quicker at increasing taxes in response to rising oil prices and decreasing taxes as a result of a decline in prices. And that's what I call asymmetrical effect. Now, oil prices usually tend to, especially when we're talking about a rise in oil prices, tend to lead to discussions on what we call resource nationalism. And I remember that was the first assignment perhaps I was supposed to write about when I joined Statoil, which is resource nationalism. And resource nationalism, you can understand different dimensions, but we can call it, let's say, government intervention to increase theoretically the benefit of a nation as a whole from the oil, from the natural resource. And during the increase in oil price in the first 8 years of the last decade, or at the beginning of the century, we saw there was a trend all around the world, and that's what the economists kind of described, from Algeria to China, everywhere. We saw governments changing the terms of investment in oil and gas industry to give the government a greater say or a greater share of the pie that is the return from the industry. And when I say resource nationalism, it doesn't necessarily mean nationalizing the industry. Remember the spectrum I mentioned at the beginning. It is a movement towards the one extreme of the spectrum, where the extreme is the nationalizing of the industry. But the reaction can be an increase in existing tax rates, or introduction of new taxes, or giving the national oil company a bigger equity share, and in some extreme cases, expropriation of assets, as we saw, for instance, in Venezuela. However, one thing we know about resource nationalism is that it's, again, like the UK experience of pendulum, it is also cyclical. So just 2 years after The Economist published that article, there was another publication where people were talking about resource nationalism was on the decline, because that was happening after the financial crisis, and some governments tended to revise their fiscal terms and their licensing terms and their contractual terms to make it more lenient. Because what happens is, when you have prices, when they are increasing, they tend to create a stronger competition among the companies for assets. So we see, for example, if you look at what happened in Angola in the licensing round of 2005, 2006, if I'm not mistaken, there was a record bidding in terms of signature bonus, where more than $1 billion was paid in signature bonus. That was a record signature bonus in the history of the oil industry then. But it wasn't just because Angola was special. Of course, Angola was recovering from the civil war. It opened its doors, and it has more or less, substantial reserves, but not, for example, of the same size as Iraq. But still, what helped the industry, the government, to acquire this kind of signature bonus was the fact that there was competition everywhere for companies to acquire assets in various countries around the world. Because then, if you remember, there was this dominant perception that the world was running out of oil. We're talking about peak oil supply during that time. So there was this kind of fear. But fast forward, when prices declined, then that perception, that kind of fear relaxed, and people realized that no, in this case, it's not companies who are competing to acquire assets. Then governments they start to compete among each other to attract capital. And this is exactly what we are having today. And I'm going to say a few words on that shortly. But one problem that we have in chasing the oil price, so if governments want to develop their policies and their fiscal terms and their contractual arrangements based on the oil price, they are going to commit a big mistake, because they are going to end up with creating greater instability. Why? Because oil price is volatile. And here I took two examples, which I like. The first graph on the left is from the IMF, the World Economic Outlook. And you can see the black line is the actual oil price, and the red lines are all the forecasts made in certain years. And you can see that they always got it wrong. And on the right-hand side, I took the EIA, the Energy Information Agency, oil price scenarios in 2015. And you can see how even at their lowest oil price scenario, they failed to capture what we are facing today. So really, we have a very poor track record of forecasting the oil price. And I'm even thinking about, there was another publication where they were looking at the next few years in 2017. They said, even in the case of a global economic recession, we're not going to see oil prices going below $50 a barrel. Where are we today? Well, we have rather check where the prices are today, but definitely far below $50 a barrel. And as you can see here, the oil markets have entered a new phase since, let's say, summer 2014. So if I look at the period between 2011 and 2014, you can see that we had a more or less a stable phase of oil prices hovering on average at $110 a barrel. But shortly after that, since summer 2014, we have entered a lower phase where, I mean, it's not low if you look at, for example, at 2018, 2017, but it's definitely lower than what we had before. And actually, if we did not have the biggest alliance in the history of the oil industry in the form of OPEC+, which managed to put a floor to the oil price, maybe we would have seen oil prices going further below what we saw. But the rules of the game have changed since, thanks to the shale revolution, which brought additional new supplies to the oil industry, global markets, and that supply is pretty flexible. It responds to changes in oil prices. And that's why I put this upper band, which was set by the shale, the US tight oil production. And this is where oil prices have been trading in that band until earlier this year, where the global oil markets, actually particularly last month, since March, where you see this sharp decline, the global oil markets were hit by the double whammy of the coronavirus, which knocked off a big chunk of the oil demand, but also of OPEC Plus not agreeing on further production cuts and the Saudis opening up their tap. And as a result, we saw this collapse in prices. And the big question is, what will happen next? And what will happen next is not just in terms of prices, but in terms of the relationship between government and the oil industry. And I already started to see a repeat of the history when prices crashed. We already start to see some leniency in coming from host governments. And here I picked up just really a couple of things from the media, from the US and from Equatorial Guinea, but there are many other places where governments are asking, what should we do to kind of maintain the competitiveness of our industry in the light of the of market conditions? So perhaps, I know the current situation is quite stressful, and I cannot help but reading the news on the coronavirus each day, if not, a couple of hours per day I spend on tracing the developments globally. But there's always a silver lining in every crisis, and this is where I see that it's not all doom and gloom for the oil industry, because there could be opportunities for having better terms than what they saw when oil prices were a little bit higher. So that's the oil price. Now, the other factor that shaped the the government industry relationship, and it can be a direct consequence of the oil price, or it can be and a direct consequence of the policies in place, among others. But here I'm talking about the investment level. So typically what we see is that when investment is rising in a country, then government believe that they can, for example, introduce a tax increase with little pain. And we often talk about the obsolescence bargain, where the government acquires the upper hand when the investment, the big chunk of the investment has been undertaken, and therefore the investor loses his leverage and bargaining power after that. And at the same time, unexpected declines in investment may trigger the opposite response. And in this case, even if you have a period of high prices. And I looked here at two countries in particular, that is Algeria and Mexico. So if you look at Algeria, Algeria has struggled to increase investment in its industry, even during periods of high oil prices. And that led them to introducing some revisions to their hydrocarbon law in 2013. And as a result, they introduced some fiscal incentives to attract more investment from the international oil companies. And even today, they are revisiting some of these to make the investment in their country more attractive. But those incentives that I just mentioned were introduced during period of high oil prices, because the overall trend in the country for investment was declining. The same thing for Mexico. Mexico announced major energy reforms where in 2014, where they decided to open the industry to private investment after 75 years of monopoly. And Mexico, again, was struggling with expanding production, making new discoveries, investing deep water offshore in the Gulf of Mexico. So if you compare Mexico and the US side of the Gulf of Mexico, you can see how the Mexicans focus their efforts onshore, shallow water, whereas the Americans, they have invested, or the international industry in the US Gulf of Mexico has invested much more heavily in deeper parts of the Gulf. That said, the current Mexican president, Obrador, when he came to power in 2018, he kind of, it seems to be gradually taking Mexico's hydrocarbon sector back to the pre-energy reforms. And part of the problem is expectations. And I'll come back to this issue in a minute, but primarily that the Mexicans feel that whatever was promised by the industry has not been delivered. And this is where we always warn. I work a lot on governance issues, and we always warn of not to set high expectations. Of course, it's important to be ambitious and to be optimistic, but if you set expectations too high, and if they are not met, that the reaction can be quite drastic. And I refer to the example of Kashagan in Kazakhstan shortly. Then there is the issue, another factor is the production life cycle. So whether you are at the beginning of the life of a province, when you make new discoveries and you're opening up your sector for investment, versus, for example, if you are a mature province where production peaked and is in decline, the attitude is going to be quite different. And here I took two examples. The first one, Israel. So the fiscal regime was first formulated in 1952. and was impressively unchanged until 2011, but because there were no significant discoveries to worry about. But all that changed in towards the end of the 1990s, and particularly in the early years of 2000, where Israel made then two of the biggest gas discoveries in the world, Tamar and Leviathan field. And as a result, the Israeli government introduced a moratorium on activities because they felt that the government take of 30% was not right, did not anymore fit the reality of the discoveries, and something had to and the regime had to be revised. And as a result, in addition to changing the regulations, the fiscal regime was tightened in 2011, and the government take almost doubled from 30% to 60%. Then you have on the other side of the spectrum, Norway. The Norwegian experience. Norway is a well-established producer and remains a significant producer to date. And you can see how this is a picture of appraisal wells and white cats, that at some point up to 2005, we saw between, let's say, the 1997 and 2005, the activity has been overall on a decline, until 2005, when the Norwegian government decided to introduce an exploration relief, where a newcomer to the industry can claim up to 78% of the exploration cost in case the exploration is not successful. And as a result, just after the introduction of this relief, you can see how the activity picked up. Not only activity picked up, but also the structure of the industry changed. So we saw like new players in the industry. At the beginning, it was more close towards the larger players and the national oil company that was then called Statoil, today is known as Equinor. But we saw new entrance to the North Sea, and it became a more varied, more balanced than what we had before. So this is an example of how the government policy can affect the structure of the industry. Another factor that can lead to changing the relationship is what I mentioned earlier. This is directly related to what we call the managing expectations, is if there are significant project delays and cost overruns, if you combine those with government perhaps unwise decision of spending the money before any revenues are generated. So when the project is further delayed, then the government doesn't get the revenues that they expected, and they have a huge bill to cover. That can backfire. And we saw that in Kazakhstan with the Kashagan project, and the Kashagan was delayed on several occasions, and the government had to interfere and change and impose a change in the equity of partners in that project, and impose fines among others. There are other factors, such as the political factors, and here I put several factors in the picture. Deteriorating government finances. When government finances are tight, they are going to look for a new source of revenue and don't feel any sympathy for the oil industry, especially in today's climate of the fight against climate change. I think the industry with the economic rent, especially when prices recover, is usually an easy target. There is a regional trend and neighborhood effect. So not only companies compare themselves with other competitors, but governments benchmark the competitiveness of their fiscal regimes, contractual arrangements, and licensing with countries, usually with geographic proximity, even though the geology might not be the same. And typically what we see is that a tax increase in one country, for instance, can be followed by copycat increases in its neighbors. And then there is the changes in political conditions, where you have completely new government with a different direction. I mentioned earlier Mexico, but I'm going to spend just a few minutes on telling you the story of Venezuela. I'm sure you know a lot about Venezuela, but most of the discussions that we have today about Venezuela's declining production tend to overlook why the fundamental reason behind the decline in investment in Venezuela and where we are today. And I largely blame that to the policies that late former President Chavez introduced when he came to power in 2000. Towards the end of the 1990s, in 1998. And what Chavez did, he he started to move the industry. So in the industry originally was nationalized and formally nationalized in 1976, and then it was open to investors, international investors in the 1990s. And you can see how production kind of responded positively to the to this opening of the sector. However, when Chavez came to power, he started to gradually take Venezuela's back to where it was in the 70s in terms of industry structure. And he did it, first of all, by introducing a new hydrocarbon law, by tightening the fiscal terms, by introducing new fiscal terms, and by increasing the equity share of the national oil company. And of course, at some point, some companies at the beginning, they accepted those changes. They did not really dispute them much. Again, because remember what I said earlier about the perception that the world was running out of oil. So they thought that they had little opportunities elsewhere. But when everybody realized that this was not the case, that there was actually plentiful supply thanks to the share revolution, then the companies were not going to accept this kind of drastic measures because they could take their capital invested elsewhere where they have better opportunities and better risk-reward balance. So, and especially with conventional oil, there is always a time lag between the time you introduce a new policy and you see the impact on investment and production. So that's why I said in Venezuela, what we are seeing today has its roots in what happened under the ruling of late President Chavez. At some point, by the way, Chavez was helped with rising oil prices because this kind of masked the decline in the suffering of the industry that became more visible once oil prices declined. And then let me now finish with, I'm conscious of time, so let me finish in terms of factors that can shape this relationship between the industry and host government, taking a look beyond the current crisis, to look at the longer term. And here I'm thinking about really the energy transition. I hear everywhere, I remember before the crisis happened, the current crisis, and at every conference I attended and every workshop and debate, people were talking about energy transition. At some point, I had an energy transition fatigue. But it's actually happening, we cannot deny it. Maybe today we are more focused on the immediate crisis, but it is a trend that is growing, as you can see in the slide taken from Irina, where you can see that the number of policies that encourage investment in renewable energy are actually increasing and capturing a bigger number of countries from all around the world. But you ask the question, who's going to pay for the energy transition? Because the energy transition doesn't come cheap. So here I like to refer to a quote by the former German environment minister in 2004, who actually compared the cost of the energy transition to only around €1 per month, the price of a scoop of ice cream. Fast forward 10 years later, another minister for economic affairs and energy said that actually that cost is estimated to go to around €1 trillion by the end of 2030. So the fiscal cost there is massive. And in the UK, and here I know I'm focusing on the government-industry relationship and upstream oil and gas investments, but even downstream, this sector is a big contributor to government revenue. So I'm thinking about fuel duties, around 44% of government total tax receipts of GDP. In the UK. In Norway, government revenues from petroleum activities account to $5.2 billion yearly. So you have here two sectors with completely different economic contribution. The renewable green sector, which still relies on government support, and the oil industry, which is a major contributor to government finances. So as you move more into the energy transition, what are the implications when the oil sector shrinks? How are governments going to close that potential gap generated because of lack of investment by the industry? However, there is another dimension to this story. Already you have publications calling on governments in major oil producing nations to revise their fiscal terms and remove the fiscal incentives that they are providing the oil industry. And some of these publications in my opinion, unfairly describe these incentives as subsidies, because, I mean, we have to agree on what constitutes a subsidy first. But they call these incentives as subsidies, and they say instead of giving the industry these subsidies, you should redirect those funds to special funds to support the energy transition. So that debate, I bet you, in the next few years is going to become even much more intense as the anti-industry lobby is increasing, and as a result, it's going to affect the government-industry relationship. So briefly, what has the industry been doing to minimize the fiscal and political risk? First of all, you cannot get rid of the fiscal and political risk. It is there, it is part of the industry. As I mentioned earlier, it boils down to what constitutes a fair share under different circumstances. It's unlikely that you can capture all scenarios in one contract. But some companies, if not, many companies actually, they resort to stability clause in contracts. And these clauses, they vary. They cover a broad range of terms. And when did I write this paper? Sorry. In 2016, I published a study with Mario Mansour from the IMF on fiscal stabilization oil and gas contracts, where we surveyed several countries around the world, and we particularly zoomed in on the fiscal stability. So looking the terms of the fiscal terms in the contract for the whole duration of the contract, whatever that duration is. And you can download that paper from the Oxford Energy Institute's website. What we found is that, first of all, not all governments offer this kind of stability clauses, but you find them usually in developing countries. They are much more common than in the developed countries. There might be very few cases, but to my knowledge, I haven't come across such clauses in developed economies. And they tend to be introduced to compensate for the perception of higher political and regulatory risk, especially when this is combined with higher geological risk. So if you have a country with great geological potential, proven reserves, then it's unlikely that you find these clauses. But when you have the perception of risk is quite high, then you tend to find these stabilization clauses. And it tends to be offered by governments in weaker bargaining position than, let's say, in governments which sit on massive oil reserves, low cost of production, well-developed infrastructure, and stable institutional framework. However, we found that these kind of contractual stabilization, perhaps some companies were putting too much faith in them because their effectiveness is questionable. After all, you're dealing with a sovereign, and the sovereign can do whatever they want with their resources. Of course, there are consequences, but this doesn't stop them from introducing some measures that affect the relationship with the industry. And especially the effectiveness of these provisions is questionable in countries where you have weak rules of law, and the judiciary lack credibility. So they become more complex to enforce. And instead, we felt that companies can achieve greater stability in other means, such as, for example, negotiating progressive and competitive fiscal terms and including a broad stakeholder base. So in a nutshell, what I try to say here, and for those of you interested in this topic, you can read the paper. What I try to say here, that even if you use contractual provisions to tell governments to behave, don't expect them to necessarily behave. And the Venezuelan experience is an example, but there are endless experiences around the world where external conditions and domestic conditions, changes to these conditions, are going to affect the relationship between host governments. Now, where does this all take us, especially given the current crisis? Well, I come from a country where we tend to read the coffee cup when we want to know what the future holds. And actually, this is a situation I feel we are in today. Nobody knows what tomorrow is going to bring. But first of all, remember that despite the talks about the energy transition, oil and gas will remain an important aspect of our energy mix. So that we're going to continue to see the industry playing an important role. However, so we are going to continue to see this conventional movement across the spectrum to continue. I say it's the same old dynamics, but there are new fundamental forces at work. First of all, the peak oil demand. So we started the century talking about peak oil supplies. Then within 10 years, we start talking about peak oil demand. And what does peak oil demand mean? Shrinking market. And what do you have in a shrinking market with plentiful supplies? You end up having stronger competition for capital between producers. And as a result, that's going to affect the relationship between these producers and the industry. So something to watch for as this competition intensifies. But there is another dimension, one which I'm unable to make any forecast because it's not anymore based on economics, but it's more on politics, is that the more successful the energy transition is going to be, the more we're going to see some international oil companies and even some national companies in countries which are aggressively pursuing climate change agenda. We're going to see these companies being crowded out. However, this kind of drive is not equally shared across the world. So here in the Middle East where I'm sitting, you see that the national oil companies are moving more into oil and gas, not away from oil and gas. So the trend that the world is following at the moment seems to be creating a new dynamics and a new market structure where we're going to see greater competition, not between IOCs and NOCs, but mainly between NOCs. And this is why I said that's going to be more defined by politics, whereas economics matter less, because don't forget, national oil companies, with very few exceptions, they follow government agenda and government interest and priorities. And this is why I said it will be much more difficult to forecast. And with that, thank you very much for listening. Should you have any question that we cannot tackle, because I can see that we went a bit above the time allocated to us, you can send me an email on this email address, but I don't know, I'll get back to Dr. Victoria to tell us if we can take any questions, or are we done in terms of timing. Thank you very much for listening.
Thank you very much, Carole. Yes, I would like to take in questions. So if you have a question, unmute your mic and then ask the question. Any questions?
I had a question. Can you hear me? This is Professor Dr. Arun Kumar from Abu Dhabi.
Yes, I can hear you very well.
Wonderful. Let me share a screen with you. Carole, it was a very interesting presentation, and because normally as a consultant with the oil industry and as an academic professor, we only look at how the oil companies react to demand and supply, but bringing in governments into the equation is a new dimension. And thank you for adding that knowledge. But I had a small question to bring up. Let me just share the screen. Is the screen visible to everybody?
Yes, it is.
Thank you. Thank you. Thank you, Dr. Victoria. So, Dr. Carole, my question is, well, today is an unusual situation where Saudi is probably producing 14 million barrels a day and ADNOC is going close to 4 million. So with all this kind of, I think the world production is about 100 million now. But in general, the forecast has been that the oil demand will go to 110 million barrels per day by 2040. But the petrochemical growth is going to go up by 100%. And the source of petrochemical is going to be oil and gas. So the question, these are other things which are commonly expected, like the market shift to the east, future of the cleaner gas, fuel, and the digitalization and all that. But my question is, you referred to something called the energy transition fatigue, but that seems to be very much coming. Like there seems to be a lot of emphasis on downstream. If the oil price is low, I think the oil companies will prefer to process the oil as opposed to put it in the gas tank and let the renewables take over or the electrical vehicles take over. Any comment on that? Thank you.
Before she responds, we can take in another question. Carole, did you get that question from the professor?
Yeah, indeed, and I'll be very happy to address it.
Okay, any other questions from our participants? Okay, so you can be addressing the question as other people think about the questions to ask.
Yeah, first of all, you're absolutely right about the fact that we tend to focus, when we talk about investment trends, we tend to focus only on oil price impact, but there is definitely government policies that we have to bring into the picture. Because, and one example, in addition to the examples I mentioned, another example that comes to my mind is the US Gulf of Mexico in the 1990s. And you know, the 1990s is called the lost decade for the industry because oil prices were low for a long period. And some experts called the Gulf of Mexico a dead province for exploration. Yet the American authorities introduced new legislation and fiscal changes. They reduced the royalty rate for certain opportunities, deep water particularly. And as a result, we saw a pickup in the investment in that region despite the low oil price environment. So that's why it's important to bring in the government policy dimension to this discussion about investment trend and what companies are doing. Then you refer to, I had to clarify one thing. When I said energy transition fatigue, it's not like the global fatigue, it's my own fatigue. Because, for example, when I went to ADIPEC here last year in Abu Dhabi, it was in almost every session, and I was introducing and commenting on every session over 4 days in the strategic oil and gas program. And I felt at the end of the day, I couldn't hear anymore about the word, the expression energy transition. It was my fatigue, but definitely it's not something that is going anywhere. We're going to see it becoming actually more intense in terms of debate in the coming years. For the demand in your slide here, and I know it's taken from ADNOC, I'm not quite sure, about the value of the figure of oil demand in the coming years, because it's true that people are talking about peak oil demand, but nobody knows for sure when the peak oil demand is going to hit a plateau, and then after that it's going to decline. And that decline doesn't need to be drastic and severe. It can be quite smooth, where oil demand will start to grow at a smaller and smaller rate, and start declining gradually. But there seems to be, before this crisis, look what we're having today is perhaps an illustration of the peak oil demand. That's just an illustration, but it's not happening yet. But there seems to be an agreement in the industry that peak demand, oil demand, is going to be around 2025 or 2030. And again, these are not my forecasts. This is what the industry, different international organizations are publishing. But whatever happens to the oil demand, it's not going to disappear anytime soon. It's just going to create greater competition because the market is going to be shrinking. Now, if you were a national oil company in the Middle East, where you're sitting on massive proven oil reserves, which are going to last for easily 80, 90 years down the line. Now, you know very well that under existing trends and policies, it's unlikely that there will be the same oil demand for your reserves in the next 80 and 90 years. So you want to make sure you convert those reserves into financial assets as soon as possible. And that's why we see the national oil companies in this region are investing heavily in expanding their production capacity, and not only in upstream. So you see their investments throughout the supply chain, upstream, midstream, and downstream petrochemicals, and expanding refinery capacity, whether domestically or particularly in Asia, which is going to be the center for the demand growth in the future. So what you are saying here, and this slide kind of confirms this kind of trend to watch for in the future. It will have an impact on the industry structure, as I said in my concluding slide.
We have some questions that have been sent via comments. One participant is asking, what happens to countries like Lebanon who are expecting bids for their second licensing round if this low oil price band continues? Should they be considering altering their fiscal regime and expectations for future licensing rounds?
Lebanon is interesting because Lebanon is a completely new province. They haven't made any discovery to date. And if you look at what has been happening in the industry, there have been several delays over the years. For example, the petrol, the offshore hydrocarbon law was passed, if I'm not mistaken, in 2010, yet the first licensing round happened 6, 7 years or 8 years later. Because there in Lebanon, it's not only the high geological risk. Yes, we are saying that there could be some oil and gas there, but we haven't done any, we haven't made any discoveries to put a more confident figure on what seems to be just estimates. And then second, the political situation has not been that encouraging. And recently, before the Corona crisis, for those of you who were watching what was happening in Lebanon, there were protests all across the country. Lebanese call it the revolution. And people took to the street, and only because of the coronavirus, those people stayed home. Now you put all these together, plus you add to that the current oil price environment. Now that makes doing business in Lebanon at this stage quite risky. Now that said, so I can see that the temptation might be there. So already the second licensing launch was supposed to take place, I think, this year. There were calls for it, or it has been deferred. I have to check the latest. That I know that some people say, okay, if under existing conditions, the government cannot offer the same terms, but on the one hand, you have this situation, but at the same time, there is exploration happening in the country as part of obligation of the existing partners. And if that exploration hits the discovery and it is confirmed as substantial and can be easily developed, so that might tilt again the balance towards the government. So it's yes and no. I wouldn't rush to revise the fiscal terms, partly because fiscal terms are not that bad. I mean, yes, there are some elements that can be improved because of the combination of the cost recovery rate and the royalty rate together and other elements, but overall the regime is not too bad. Let's wait and see what the outcome of the exploration efforts is going to be, and whether any discoveries made are going to be commercial or not, and what developments plan, and then we can see what will happen next.
Okay, thank you. And then we have a question from Dorothy. Anyone on the chat who wants to ask a question audibly by video before I read out the questions in the chat? Okay, we have a question.
Yes. Victoria, I've got a question. My name is David.
Yes, David.
My question is in respect of a country like Nigeria. I think Nigeria has been toying with the idea of reforms. The Nigerian government have been on the issue of reforms for the better part of the last decade. And somewhat, there are people who hold the view that this has led to the divestments we are seeing in the Nigerian oil industry and the move towards offshore. So I just want to have a sense of what your view is on the Nigerian situation and how the Nigerian government's position with the IOCs is impacting investments. That's one. Then secondly, there are a lot of people have the view that really gas will be the transition fuel, natural gas. And so do you think that for frontier countries and countries with new discoveries, it will make better sense for them to begin to focus more on gas?
Right. Shall I take these two questions, Victoria?
Yes, please.
Right. So first of all, Nigeria, I should have mentioned it in my list of countries in terms of relationship with investors. It is perhaps another tricky, I wouldn't compare it to Venezuela because it's entirely different, but definitely their politics have come into play and have affected the relationship with the industry. When I say politics, not just the political situation in the country, whether there is security or not. I mean, of course, you have the problem with Niger Delta, which remains to date. But in terms of attitude towards the industry, the private sector in general, that has created instability in the country and has delayed much needed fiscal reforms and contractual reforms. I remember that Nigeria has been talking about reforming its fiscal regime to make investment more attractive for years. And I have reviewed several drafts of the fiscal policy and energy policy the country was considering. And still now I am doing exactly as we speak this week, I'm doing exactly that several years later. And the problem with Nigeria, if you look at the number of discoveries, the investment trend, the production trend, I think Nigeria has been underperforming given its potential. Its potential can be better exploited, but this kind of instability created in the country vis-a-vis private investment, especially at a time, don't forget again, don't look at a country in isolation from what's happening elsewhere. Capital, companies' capital is international. They look at the world, they don't look at a specific country in isolation of the rest. So at a time when other opportunities are available elsewhere, perhaps cheaper. It is therefore time for the Nigerian government to push faster and firmer with reforms. And I think they are, based on the information I received recently, that they are heading into that direction, but let's see. The problem in Nigeria is that the system, the fiscal system, the contractual arrangements, for me, I find them unnecessarily complicated. And it's not just about providing fiscal incentives. Sometimes a simple progressive fiscal regime can be much more attractive to an investor, even if the tax rates are higher than a regime which is super complex, has so many hidden layers, and you get lost into the details, even if the headline tax rates are lower. With respect to your question about gas as a transition fuel, that is a big question. Everybody thinks, most of people believe that gas will be the bridge fuel that would link our current energy consumption pattern, which is heavily tilted towards fossil fuels, that is oil, coal, and gas, towards a greener future where our main source of energy will be provided by renewable energy and nuclear power. And definitely there is a great potential for gas, because gas came to the picture much later than oil. It started to become popular, I would say, particularly after the first oil shock and the switching in power generations from oil to gas in many places. And gas is attractive because, first of all, I mean, it's plentiful. There are plentiful. The gas reserves have been growing rapidly, and it's you can find it in many places. And also, it emits less carbon dioxide per kilowatt hour compared to oil, and definitely compared to coal. So it ticks on many boxes. However, there is one aspect that people are not often thinking about, is that gas competes with each other fuel in each of its applications. So whatever you think there's an application where we can use gas, you can easily use any other fuel. With oil, however, this is not the case. So if you think about the transport sector, oil is still king. Whatever you hear about electric vehicles, oil is still the dominant fuel for transport. Think of aviation, think of whatever, vehicles, etc. So because of this feature of natural gas, we cannot tell 100% that yes, gas is the future, that's it. Because what will happen to gas if it becomes less competitive to other fuels in the future? So that's something we have to keep in mind. But I still believe that for countries which sit on proven gas reserves, it's worth investing in building the infrastructure and monetize on those reserves, as long as there is demand for oil and gas. But of course, you need to have all the legislative framework and fiscal framework correct in place to make the most out of your resource. And mind you, many countries, whether in Africa or Latin America or the Middle East or in Russia, they still burn that important fuel. I'm thinking about Iraq. Iraq is perhaps the second largest gas flaring nation in the world after Russia. Despite the fact that Iraq is a major oil producer and they sit on substantial gas reserve, they have not invested in monetizing that important resource. So I would definitely encourage governments to be more serious about their gas reserves.
So there's a question that has been sent to me privately from Dorothy. She's asking you to make some comments on the relationship between oil companies and local governments, and how can local governments protect themselves from exploitation by national governments and oil companies? Okay, I think you can address that. And then there's also a general question on the group from Sang. He's saying that I read today some document on CNN about surplus production with a low demand as a result of COVID-19, which has led to stretching of storage facilities. I'd like to understand how today's surplus will lead to tomorrow's scarcity, especially now that producing companies have started cutting production. So I think we can address those two questions. Is that okay, Carole?
Yeah, definitely. So for the issue of local government, and particularly the question of local content, this is a thorny issue in many countries, and it deserves a lot of attention. But it's a policy matter. Of course, oil companies, and I think many of them, especially in today's environment and their commitment to governance and transparency, they are giving greater attention to this issue. But at the end, it is down to the host government, the federal or the central government, who should devise a competitive and effective and efficient local content policy, which is also transparent. Because I've seen in many cases where local content policies have been exploited and abused in a sense where they fueled corruption. And this is where we talk about the importance of transparency, but transparency on its own is not enough. It's the whole system of governance and accountability. And in some cases, some figures have been added, like I know, like in Lebanon, for example, in terms of local content, the legislation or the contractual arrangement refers to companies having to hire at least 80% of the workforce. They have to be local. While I understand the rationale behind it, but you don't want to face the risk of not being able to meet that proportion, which I don't think would be an issue. But the danger, in my opinion, is that again you create high expectations, because you might create the impression that you would end up creating thousands and thousands of jobs. And it's exactly what we saw in Lebanon, where when people were talking about this kind of a provision of 80% of the workforce to be a Lebanese minimum of 80%, then we saw universities across the country rushing to giving degrees in energy, and then people enrolling and taking those degrees. But that what you find today is lots of graduates who are desperately looking for a job, and they say, oh, hold on a minute, we were promised thousands of jobs. Well, no, they were not promised thousands of jobs. It's just the interpretation or the misinterpretation of that provision. So again, we go back to this issue of managing expectations. But there is lots of literature, lots of evidence on how to devise an efficient and successful and transparent local content policy that is inclusive, that brings everyone on board. But again, as I said earlier, it's quite a gray area, because if it has been exploited in many countries in the developing world, where it encouraged, not discouraged, corruption. And I was witness to one arrangement, for instance, where in one country, I'm not going to mention it, where the private company was complaining, had a dispute with the local authorities because they wanted to build a school as part of their commitment, a school and a hospital, if I'm not mistaken. But the government insisted on doing it themselves. So they kept on asking for the money, and the company said, no, we're not going to give you the money, but we're going to build that. And I wasn't sure, because the company did not trust the government that it was going to invest it properly. And at the same time, the government kind of portrayed the company as not meeting their obligations. So again, which side would you take? But I remember that fueled a whole kind of unrest in one African country. For the second question about the surplus of production today, which, if I'm not mistaken, it is C. So there is that companies are producing less and investing less, and as a result, that could lead to scarcity tomorrow. You know, I heard that argument, particularly post 2014, when the oil price declined, and there was a decline in investment, whereby both the International Energy Agency and OPEC, it was pretty unusual for me to hear them saying the same thing, warning that the decline in investment, that companies are cutting their capital expenditure, is going to lead to lower supplies, and as a result, it's going to lead to a tighter market, and that will result in a spike in prices in the future. Guess what? This did not happen because of several factors. First of all, when you look at the decline in investment, you have to be careful of the cost inflation element, or deflation in this case. So typically what we see in the oil industry is that cost follow price with a time lag of 9 to 12 months, or a bit more or less. So in a sense that when prices come down, we tend to see also cost coming down. So as a result, what you would get for $100 during periods of high oil prices, you might do exactly the same for $50 when oil prices are low. And I remember in 2013, when oil prices were hovering around $110 a barrel, the CEO of Chevron, if I'm not mistaken, said that $100 for the industry oil price was equivalent to $25 for them because of the cost inflation. So again, I'm not really too worried about the lack of investment today creating scarcity tomorrow, because there are plentiful of supplies and the demand may not continue to grow relentlessly as we saw before. So whatever we were talking about before as peak oil supply, they have been replaced by peak oil demand. And don't underestimate investment in the shale industry. Again, the whole thing that is a revolution that changed the fundamental of oil market. Yes, it is struggling today because it responds much faster to changes in oil prices than conventional oil, but I don't think we heard the full story of the shale industry yet.
So we shall have 3 more questions because we've run out of time.
Yeah, I thought there's still going to be only one.
All right, okay. Okay, what we can do, our participants, you can send in the questions because she has shared her email address, and I'll be sharing with you more material from the presentation and also other relevant material. But I'll just read out this question concerning Corona. People are asking, is it the right time to trigger the force majeure clauses? And also another question from Fiscal. He's asking, with the current risks in the oil and gas sector, how can governments or oil companies rework and look at the oil and gas industry risks going forward? Like, how can they handle the risks in the future? And also, is it the right time to trigger the force majeure? For the other questions, we shall be sending you emails with relevant material, but you also got Carole's email address, so you can always feel free to reach out to her. So Carole, I think that will be the last question with respect to the current situation and risks, and that will be the end of the webinar.
Yes, I will give you very brief answers on both. For triggering of the force majeure, I've seen much more serious situations involving wars and serious security concerns that did not even trigger the force majeure, because I can see the concern today, but don't forget that the oil industry is perhaps like any other industry in the extractive sector. They have to stay where the asset is. So, and the asset is immobile. But if you are, for example, a car manufacturer, you can perhaps close your doors and then move your factory elsewhere if conditions deteriorate. But typically in many countries, I've seen in some cases that the last to leave the country were the oil companies, and then they triggered the force majeure when there were some serious wars and that pose some major risk to their operations and to their staff. So at this stage, I'm not quite sure we are there yet with the coronavirus, because yes, people are working from home, but with the oil industry, and again, I'm not a technical person, but I know a lot of operations, especially with the digitalization revolution today and the AI, many operations can be done remotely or whatever. So again, I'm not quite sure we are yet there to trigger a force majeure, but again, it depends on the circumstances of the investment and where the company is. But as I said, I've seen worse situations that did not even trigger that force majeure. For the second question, I'm not quite sure if I understood it right, but let me try to come up with an answer on what companies and governments should do to face the current risk in that the sector is facing. Again, there's no silver bullet or one single answer. And if I say cooperation. It may sound like a cliche, but I think definitely a cooperative attitude, a dialogue, and I'm thinking here about the UK and Norway. I know these are developed economies and they have well-established institutional framework, but their stories are fascinating. I mean, they went through the whole cycle of rapid growth, peak and decline. And what amazed me when I first started my career, I focused particularly on the North Sea, is this direct engagement and constructive engagement between the industry and the host government. So there was this openness in the dialogue between the two parties, and that's why we're seeing that the North Sea is still an important producer, perhaps not the same important producer that it was many years ago, but it's still an important producer today. It was quite active industry, even though I mentioned the UK fiscal regime as being perhaps one of the most unstable in the world, but there are other features in the regime and the whole investment climate in the country that makes the UK still an attractive province for investment. So I'm not too sure whether this was the question, but the way forward would require more, not less, cooperation and more openness and dialogue between the industry and the government, because at the end they share mutual benefit, which is to extend the life of this industry as long as possible, given the major dependence of many countries around the world for on oil and gas revenues.
Okay, thank you very much, Dr. Carole Nakhle, and thank you very much, our participants. As I mentioned, I'll be sharing with you all the material, papers, and videos concerning the subject, and we shall also be hosting more webinars at the Extractive Hub, featuring different experts. And for the people who wanted the presentation and the recorded version of this webinar, I have all your email addresses I'll share with you, and also feel free to reach out to Dr. Carole Nakhle if you have any questions with respect to this presentation. Carole, thank you very much. It was a pleasure hosting you.
Thank you, Victoria, for organizing this, and thank you everyone for your patience and for your very interesting questions, and enjoy the rest of your day.